With interest rates hovering at decade highs and uncertainty looming over the Federal Reserve's next moves, investors are facing a complex fixed income landscape. Short-term yields are attractive, but so are long-term opportunities, especially if interest rates eventually fall. So what is a smart income investor going to do? This is going to be an SGOV, which is the iShares 0 to 3 month Treasury Bond ETF, combined with the iShares 20 plus year Treasury Bond ETF TLT combo, a surprisingly simple yet powerful portfolio pairing that gives you the best of both worlds, which is going to be safety, yield, and long-term upside potential. So in this video, we'll break down what SGOV and TLT are, why they work so well together, and how to build a resilient, income-focused bond portfolio with just these two ETFs. First, let's jump into what exactly is SGOV. This is the iShares 0 to 3 month Treasury Bond ETF, and it holds ultra short-term US Treasury bills, which are considered some of the safest assets in the world. You're getting exposure to these US Treasury bonds with remaining maturities less than or equal to 3 months. And another good thing about it is it has a low expense ratio of 0.09%. This ETF is extremely liquid because it is traded on the stock exchange. You can simply just buy this ETF and sell it immediately and you'll have your cash back. Versus investing in treasury bonds itself, you do have to wait that 1 to 3 month expiration date in order to cash out your investment. I personally use SGOV as my emergency fund holding. I have about $20,000 into it, which is about 200 shares. So every single month I've been receiving dividends, which is going to be about $70 every single month. And the best thing about it is it's very tax efficient because you do not pay any state taxes on this ETF due to its holdings, and you're only going to be paying that ordinary income tax from the federal tax bracket. And I personally love this more than a high yield savings, such as Capital One high yield savings, because it has a higher dividend yield compared to the interest rates on a high yield savings. And combined with that tax efficiency, you're going to be making a little bit more money on your uninvested cash. And as we mentioned earlier, this is essentially risk-free. There is essentially no volatility with this ETF. In the spikes that you do see, you may see your portfolio balance fluctuate a little bit, but this is all because of the dividend you are receiving. It's going to run up the dividend amount, and then after it pays out that dividend, it's going to drop again. But essentially, it's going to hover around $100 per share. You're not going to lose any money. And if you do buy this ETF and then sell it before the dividend, you are going to be making money even though you are not receiving that dividend, because the share price is going to go up a little bit in value. So you are pretty much getting that daily interest accrual. So with the Federal Reserve continuing to keep the rates elevated, SGOV remains a highly attractive short-term income tool. Now let's briefly go over TLT, which is the iShares 20 plus year Treasury Bond ETF. And this does have a little bit higher expense ratio of 0.15%, and we'll go over why this pairs so well with SGOV in a bit. But as the name suggests, it basically holds long-term 20 plus year Treasury bonds in this portfolio. And just like SGOV, it's highly liquid. It just trades on the stock exchange. But unlike SGOV, this is going to be a more volatile ETF. We can see there are going to be share price fluctuations. And this is also going to be paying a dividend yield, currently about 4%. So it's a very attractive dividend yield. And while SGOV is used as a cash alternative to park your funds safely, the use case for TLT is going to be long-term income as well as capital appreciation, because this is going to be directly correlated to interest rates. So if the interest rates fall, this ETF is going to appreciate in value, because as we saw during COVID, when interest rates were at all-time highs, because when we saw during COVID, during the pretty much no interest rates market, This ETF pretty much went to the moon, $171 per share. But if the interest rates end up increasing, this ETF is going to fall in share price as we have saw over the last few years. And in my opinion, TLT has been beaten down over the past few years, and it's a great price to buy into because if rates start to decline, whether due to a recession or falling inflation, TLT stands to gain significantly in price in addition to paying monthly dividends, because this also does pay out monthly dividends. So in my opinion, these are better places to park your cash for investors holding a large amount of idle cash. The SGOV plus TLT strategy offers real advantages over traditional options like a savings account or even CDs, which tie up your money for up to a few years. So why do we want to combine SGOV and TLT? Well, SGOV and TLT are basically opposites on the yield curve. One is ultra stable, which is going to be SGOV in short term, while the other one, TLT, is long term and volatile. And together they balance each other out beautifully. SGOV is going to give you a stable over 4% yield with almost no price risk. It's perfect for the current high rate environment and a great spot to park your cash while earning some solid monthly income. TLT is a long-term play. It is a rate cut play. So if the Federal Reserve begins lowering interest rates, TLT could soar in price, and historically, long duration bonds outperform sharply when rates fall. It's best to combine these two because you're getting that diversification. You're not making a single bet on whether rates will rise or fall. You're positioned for income now as well as capital growth later with TLT. And while these ETFs are not going to make you rich and they are income focused plays, they are also going to give you a recession hedge. If the economy slows, stock markets may fall, but TLT tends to rise in value during risk-off environments. And SGOV, as we saw, it's going to hold steady as it exists. So this combo can protect your portfolio during turbulent times. For my personal portfolio, I currently have 200 shares of SGOV, and I plan to put 10,000 or 100 shares into TLT, which is pretty much going to be a 70% SGOV and 30% TLT split. And this is going to be pretty much for my emergency fund, as well as any uninvested cash I'm going to keep into SGOV. And especially since Robinhood normal users, non-gold users, are only going to be earning 0.01% interest on uninvested cash, you might as well have that money work for you a little bit. So might as well plop that into SGOV. Now, if you do have Robinhood Gold, you are getting that 4% yield, which is a good yield, but you could be a little bit more efficient with SGOV, in my opinion. But in my opinion, I believe there's a lot of potential with TLT, especially with how high the interest rates are and how low of a price point TLT price is at $86 per share. We haven't seen a level like this since 2007. So in my opinion, there is a lot of potential upside for TLT and a lot of money to be made in a simple bond ETF. Now, as income investors, these ETFs, SGOV and TLT, are not going to make you rich, as we mentioned earlier, but we do have to consider all of our options. We want to diversify our portfolio, not only have that high yielding income, but also some safer investments to fall back on when the market takes a dip.